Welcome to episode 13 of the Corporate Real Estate Insider Podcast. We are back with another episode. We have a slew of interesting topics we're covering today, starting with discussing the recently released Gallup State of the Work report. Brian's going to be covering that here in just a moment. We're also talking about some capital markets and sale-leaseback updates, what's going on out there as it relates to interest rates and how that's affecting the pricing of these different buildings. Also going to be talking about some international markets as well as appraisals. So have a full slate of topics today. Let's jump right in with Brian on the Gallup report.
Yeah, thanks, Tucker. So if you're not familiar, Gallup releases, I believe it's annually, a report. They poll or they go out to 60,000 people globally. So it's a global report. And some of the highlights that are just, I find so interesting, just to run through them. So the percentage of employees thriving at work is at all-time highs, which is around 23%. However, the majority of the world's workforce are quietly quitting. So 59% of the world's workforce is quietly quitting. 18% is actively quitting, which actively means that you're actively taking steps to undermine leadership or the direction of your company. So I thought that was just mind-blowing. I think a third point is employees are still feeling very stressed at work. So it's at all-time highs. And the last point is engagement. So a big piece of the report is around what causes people to quietly quit or actively quit, and engagement is a big piece of that. And this is no surprise. Engagement has almost four times more influence on employee stress than work location. So people will feel less stressed. They'll be more engaged. They will feel less stressed if their engagement is high, regardless of where they have to commute to work. So those are some highlights. I thought was really interesting.
Can you tell me a little bit more about this actual quitting at 18%? I would think of actual quitting as quitting your job, not, staying employed and trying to undermine. Is that the definition the report's using?
If I said actual, it's actively disengaged. So they call it loud quitting. So what the definition is these employees take actions to directly harm an organization, undercutting its goals and opposing its leaders. At some point along the way, the trust between employee and employer was severely broken. Or the employee has woefully mismatched to a role, causing constant crisis. So that's 18% of the global workforce.
Nearly 1 in 5 actively trying to harm the companies that they work for. That's pretty insane.
You know what stands out to me, and what did you say? 23% are thriving, and that's an all-time high. Yeah, that's depressing. I'm thriving. Like, are you guys thriving? Are we an odd subset of the workers of the world? Aren't you supposed to thrive at your work?
Honestly, I feel like I thrive every day. I love what I do.
23%.
This report is scary.
Yeah.
Well, I think part of it might be the fact that we're coming off of, this time where, by and large, everybody, the whole country was working from home, less, food service providers and healthcare workers and so forth. And it might just be a function of, oh my gosh, I have to get back to work. And now I'm getting, called back to the office, even if it's just a couple days a week. This is horrible. I'm used to working from home. And, that alone might just be enough to tip the scale. When in fact, it's just a reversion to the mean. But some people just, I don't know, maybe they can't handle it. But
maybe I'm just Pollyanna. I mean, we just got through a pandemic. We're back to work in more flexible and creative ways. We have good jobs. If you're working, I just don't get it. 23% all-time high for thriving. That's
If you want my take on it is, I think a lot of what Owen, you're exactly right, but it's more of the crisis is in management. It's in the ability the workforce around them is changing, not only in terms of what they want, but where they are physically. And I think managers, all the way from senior leadership down, are really struggling at these organizations to keep their people engaged the old way. The old way was they're at their desks, and you had a very direct line of sight or direct contact to keep people engaged and happy and a part of the team. And now they have to manage a whole different way, and it's really changed their ability to be effective. Is the way that I see it. If anyone on the podcast is interested, it is a public. You can get it for free. The report is out there. We downloaded it, and certainly reach out if anyone wants it, or just go on the Gallup Global Workplace 2023 report is the data source.
I'll go next with an article. This comes from one of the largest full-service real estate brokerage firms, doing a report on where real estate rents are on the rise. I'm sure they're looking for a good news story. They appear to have found one, and what they're describing are urban fringe neighborhoods. They give the examples of Chicago's former meatpacking district, Fulton Market, where they're claiming 43% rise in rents since 2019. Seoul's Gangnam neighborhood, rents up 24% over the last 5 years. The South End in Charlotte, North Carolina, 33% rent growth. Also, Berlin's Prenzlauer Berg neighborhood. The idea being people aren't going back downtown, but they're looking to go back to the office, and these offices on the fringe of the downtown urban core seem to be in high demand. It's an interesting premise. What do you think?
Yeah, I think I've heard a lot about this over the last year. I think we talked about a little bit on an earlier pod, just personally predicting that as you see people continue to push towards working from home and having a hybrid workforce, companies are going to try to figure out how to, instead of bringing their people to the office, bring the office to the people. And certainly there's a benefit for these, and I wouldn't even call them fringe, but they're the neighborhoods that people want to be in, because there's all of the components of a real neighborhood. There's housing, there's retail, there's restaurants, and now there's office. And that live, work, play that's been a phrase that the industry has used for a long time is now coming to more of an urban environment, where if you just think of New York City, like, do you really want to live or work in Midtown South, where you're not going to live there? Your commute's difficult at best, or very long and difficult. Or do you want to work in Brooklyn and walk to work, right? And it's a game changer for these large urban cities that the people don't want to work 5 days a week from the office. So the days they come in, they can walk down the street, or they can jump on the bus, or they can ride their bike, rather than sit on long train rides or sit in their car for hours in traffic. So it all makes sense. It's scary in the sense that what's going to happen to these urban cores. It's a topic we've continued to talk about, but it's great to hear that there's a sign of life, at least in these fringe markets for large population centers.
We have talked about this before, and maybe I see everything with an economic lens, but my prediction is that the rents in the urban centers will come down enough to lure companies back in for financial motives, just like the rents in the suburbs originally drew clients out to less expensive real estate. It's just going to swing back and forth, and economics will be the driver, other than the obsolete buildings that are going to be raised entirely. But I think economic forces draw people out and back.
So that the premise of these fringe markets doing so well is, the neighborhoods that people want to be in, great housing, the ability to, live, work, play, like what Brian was saying. So how do you think about this? In Los Angeles, there's more multifamily construction in downtown Los Angeles than there is in any other part of Los Angeles. Interestingly, downtown also has the highest multifamily vacancy rate, and that's because primarily there's been so much new construction for apartments that have been delivered. There's been 2,700 apartments that were delivered in the last 2 years in downtown LA, which is a massive amount of apartments, right? So do you think that over time, these urban cores become much more attractive? People start living there, and then all of a sudden, if you're trying to bring the office to your employees, being in downtown actually accomplishes that, because you could have such a high percentage of your team that, lives in this walkable area that's also affordable because vacancy's highest there than anywhere else in LA.
That's a good question. I mean, we've got a tremendous amount of multifamily here in Seattle, much of which is mirrored what you would see if you went to Vancouver, BC, where they've got a tremendous amount of multifamily in the urban core. But I'm seeing absolutely zero translation between the development and eventual occupancy of multifamily downtown and the occupancy and the leasing velocity of office space downtown. I think they like living downtown for reasons that have nothing to do with being close to the office. So I don't think there's going to be a correlation. I do think, however, that having multifamily in a downtown urban core helps with the vibrancy. One of my complaints about visiting Los Angeles many, many years ago, over a decade ago, was that, downtown by and large, after 5 o'clock there wasn't much going on. Like, it wasn't a place to be. It wasn't that it was unsafe, but it didn't provide a lot of nightlife, restaurants, bars, that type of thing. Whereas I would hope that with the increasing amount of multifamily, you're going to see a lot more retailers kind of activate the downtown core, which makes it more of a 24-hour city like New York. I think that in itself will help all of downtowns, but I don't think there's any correlation between multifamily and office. But I could be wrong. There could be a study out there that could prove me wrong, but that's just my own interpretation.
Yeah, I do have my opinion is that over time there's going to be a strong correlation between the two. In cities that have gotten the other aspects of living and working in an urban core right. I mean, LA's putting all this housing up, but is it really a place that you want to go out at night? Like you said, is there the retail there? Is the city feel safe? Is there good public transportation? Like all the things that you need. In certain cities like Boston, it's working, right? It's a smaller city. It's easier to make it happen. But the cities where you don't see that good mix of a good safe environment, strong work base, and housing, you're seeing one of those pieces fall apart is really causing, I think, a delay in that and the evolution of that trend, right? So I think put the housing there and people are going to end up living there and they're going to want to work there because it's a lot easier to commute across the street than it is. But you got to bring the other pieces together, and that takes time. Like LA is not going to solve this overnight. Listening to even this morning, Barry Sternlicht was talking about this, and he said residential, like no one thought residential is going to continue to see rent growth that they've seen through this last cycle, right? So these last few years, you'd start to see all this new inventory come to market. You'd see interest rates coming up. You see consumer demand still strong, but more price sensitive. Residential still growing like crazy. So are we poised to see a much larger rent growth on the backside of this uncertainty? Like it could be, you could see double-digit rent growth again in some of these buildings. And what does that mean? It means they're going to continue to build housing because rent growth is still there, which means it's going to bring more people down there. And I think eventually it should be a driver to what we were talking about, bringing that the employees back to these urban cores.
So a couple things. I probably am building a reputation for being the contrarian on the podcast with everything that's going on, but this gap in economic stats that have been released for the first quarter in the actual economy is crazy. And that's just me. I'm not an economist, but I'm reading what the Fed's pumping out and what I'm seeing in real life from talking to my clients, looking at what's going on in the cities that we all work in across the country. It's just crazy. And I'm talking about jobs numbers, GDP, all of it. It just seems off. And so bringing it back to real estate, I mean, look at what's going on in Silicon Valley right now, guys. I mean, it is Silicon Valley companies are dumping office space at a really fast, accelerating pace. And during the pandemic, a lot of them were gobbling up space, taking space. And we were starting to wonder, at least I was, like, what do they know that we don't know? Like, they're all taking down space when everyone is like working from home and nobody's going to the office. And now they're finally like, okay, we took too much or we have too much, let's get rid of it. Now, I want to suggest it's not because they're working from home, because Google, in fact, has come out and said that office attendance is part of your performance review going forward. So these big companies are suggesting that like you don't get to work from home 5 days a week. That is no longer an option. So it suggests, however, that they took way too much space anticipating job growth and just their employee headcount. And they're finally starting to realize that it's time to let go of space. We took too much. We don't have that population or need space for that future population anymore. We're a much smaller company, or we're going to be a much smaller company going forward. And so what's astonishing about Silicon Valley is Silicon Valley for years has been like one of the hottest real estate markets in the country with some of the highest rents, where you would surpass even what you would see in downtown San Francisco. And Google recently has put 1.3 million square feet of space on the market. You've seen vacancy in Silicon Valley push as high as 20%, just behind downtown San Francisco, which is at 25%. Since 2019, we've seen sublet space, so space being subleased by the big tech companies in Silicon Valley, go from 2.7 million to what today is 7.6 million square feet. And so I just find it rather astonishing. And then what's even crazier is that I listen to a lot of earnings calls from the major landlords in the country just to hear what they have to say. And this past week, I was listening to Boston Properties, and they're building a 1.1 million square foot office complex in Silicon Valley. Huge building, delivers in 2025. And it's just so I don't misquote, because I actually wrote this down. I had to stop the earnings call and write this down. The president of Boston Properties said, quote, "There's not a lot of technology demand in the market today." And then when referencing that project, it's called Platform 16 in Silicon Valley, 1.1 million square feet of spec office they're building, he said, quote, "There are no conversations going on there," when he was asked about the leasing activity in that property. And so to think of a landlord building 1.1 million square feet of brand new, amazing, beautiful office space in Silicon Valley, a market that historically has performed extremely well, even through recessions, and they don't have a single conversation going on with a single company about leasing space, that's crazy. And the disconnect, and this is where I'm going with this, is like, it's just the disconnect between what some people are suggesting is what's going on out there and what I'm seeing based on conversations sometimes with CFOs and CEOs, leasing activity in the market, the amount of sublet space hitting the market. There's just a massive disconnect. And there are certainly companies doing well out there. And even the companies that are laying people off, they're doing well. But it's just not correlating, in my opinion, with the job numbers and the GDP that I'm seeing come out of the Fed and the Bureau of Labor Statistics.
Hey guys, let's not forget this all happens, has happened before. The tech wreck, 2000. San Francisco, the highs are higher and the lows are lower, and the cycles come on quicker. I'm not sure this is fundamentally different. San Francisco, Bay Area, Silicon Valley, it's a remarkable place. Center of tech innovation, the network effect of the, venture community. That's all right there beneath the surface. How long it takes to bring it back, I don't know. But there will be another wave of innovation, acceleration, and growth. Just in the Bay Area, the highs are higher and the lows are lower. It's always been that way. And at the end of the day, it's still a wonderful city.
Nobody's suggesting it's not, John. I think the Bay Area is awesome. I love it. I used to vacation there with my wife just before we had kids as like a couple's trip. We'd go down there for 48, 72 hours. But the enormity of what's going on and what is now being reported is like a 180-degree difference than what we were hearing during the pandemic. I mean, in downtown San Francisco is no exception. Westfield Mall defaulted on their loan. The two biggest hotels in downtown San Francisco defaulted on their loan. 2,900 hotel rooms. They're giving the buildings back to the bank, citing the lack of occupancy due to the crime and what's going on in San Francisco. So the correction we're seeing now, I think we're just starting to see the beginnings of it. I think the pandemic was just a precursor. I think what we're seeing now is that companies are finally going, you know what? We probably took too much space. Again, work from home. I'm not even bringing that into the equation. I'm talking about people that just took too much space, anticipating massive surges of employment and the amount of employees they have to have space for. I think they overextended what their actual needs are going to be. So I think what we're seeing is finally big tech is catching up on the office space side with their usage and their needs.
What do you think is a bigger concern? This question comes from your comment on the Westfield Mall. The Westfield Mall defaulting on their debt, or the major retailers of the Westfield Mall pulling out because they don't think it's the right place to be doing business?
Yeah, I've spent a lot of time learning about what's going on in San Francisco from up here in Seattle, because we're not, in some respects, not far behind them. We're almost like their sister city, I would say. And what's astonishing about San Francisco is Union Square, which has historically been one of the hottest, places to visit when you're in San Francisco, and especially in terms of retail, has lost 70 retailers in the last 3 years. And these are retailers like Ray-Ban has moved out. Nordstrom closed their flagship store there. The list goes on. Name a major retailer. The Gap, who was founded in San Francisco, closed their store. And so what's more concerning to me is the lack of confidence. Major name brand, worldwide brand, essentially, retailers saying to the public, we don't have faith in this city anymore, and therefore we're closing our store. That to me is more concerning than Westfield defaulting on their loan by far.
We've talked a lot about all of the different asset types on this podcast that are doing poorly, right? Industrial is finally slowing down. Life sciences, we have this tsunami of sublease space and new construction coming on the market at a time where in most life science hubs, demand is down by 3-4x compared to where it was, during the heat of the pandemic. Are you all aware of any real estate product types that are actually performing well? And by well, I don't mean like industrial still performing well, for example, right? But rents are coming down. It's headed in the wrong direction, or maybe in the right direction if you're a tenant and hoping to pay lower rents. But you all know what I mean. Are you aware of any large scale product types that are doing well? I mean, even when you get into some of these other sectors like self-storage and things like that we don't regularly talk about on the podcast, those are also not doing well. And I'm curious if you all are aware of anything that is trending up. I am aware of one which I will share.
Yeah, I think pre-leased or built to suit real estate is just performing better than any asset class. As long as you get a signed lease before the building's built, I think you'll be in good shape. No, I don't. I can't think of a single asset class other than on the residential side. And I wouldn't say performing well. It's holding up. I think because of the lack of inventory on the markets, you're not seeing any significant price decreases yet in single family residential.
Yeah,
or multifamily residential.
I would say I'm interested to hear what you have to say, Tucker, because I don't see a single asset class that's just as performing well coast to coast, regardless of its locale. I do see projects thriving, like crushing it. I mean, there's retail projects I visit here in Seattle, for example, not in downtown, but in the region, malls and outdoor shopping centers that are, you go there and it feels like it always has been. It's every single suite is leased by a retailer and there's shoppers and so forth, but it's very location specific, because I'll go to other retail centers and it's a ghost town. So I don't want to just pick on retail, but I think it's location specific, because there are certainly properties of all asset classes that are thriving, but I'm not aware of one that's just by and large, regardless of where it might be, is thriving across the country.
How about this? What about industrial? And by industrial, maybe I don't mean, the large logistics centers, which, may be threatened by shifting consumer patterns. But imagine 50,000 square feet and smaller industrial, sort of the maker space. These people, that space is still, low vacancy rates. What do you think?
Yeah, I think that industrial space in supply constrained markets that are more manufacturing oriented versus like third party logistics or giant warehousing operations, think more like last mile type of stuff, is still doing very well. But the asset type that is performing really well, and I suppose that this is a little bit unique to Los Angeles, although this obviously exists in many other cities and areas around the country, is production space. space for people making content, movies, TV shows, and also content creators doing YouTube, TikTok, those types of things. That product type in Los Angeles is doing very well. And there is, in fact, more development that is underway to support the success of those types of assets. What's challenging, and what I think becomes a little bit confusing if you're looking at the data, is that there are a number of these large companies that produce content that have large studio spaces. You think, Netflix, Amazon Studios, people like that. And many of those companies are in this period of trying to reduce costs, shed real estate. And if you look at the space that's actually being shed and you really just isolate that, it is predominantly the office space. Very rarely is it the production space. And the production space that they are shedding is generally being picked up very quickly by other people in the content production space. So as far as I'm aware, that is the only real estate product type of reasonable size that's actually doing well, and certainly is in Los Angeles. And based on my research ahead of this podcast, it appears that it is doing similarly in New York, Atlanta, and some of the other major filming and production hubs around the country. It just was announced over the last week or two that a high-rise tower in downtown LA is being converted to residential. It's a 650,000 square foot high-rise building that they're converting to almost 700 apartments. One of the more narrow floor plates, still a very large floor plate. It's more of a almost rectangle with some additional angles that's long. Very interested to see the floor plans for this building, though, because it's not a building that you would think is going to be converted to apartments easily. It's one where you look at and we'd say, okay, maybe there's going to be some interesting window lines and depths in a lot of these apartments, but maybe they can pull it off. Whereas the majority of these other buildings in downtown LA have such wide and deep and large floor plates that I think it's impractical. So be interesting to see how many more announcements similar to that we have over the coming months and years.
Yeah, the conversion to multifamily from a once office building is, I think, insanely risky, and I would not want to be betting on that. And the reason being is that not only are you taking an office building that was purchased based off of a future income stream that was perceivably going to be there into perpetuity, now you're getting rid of every single piece of income, so your NOI goes to zero. You're spending millions and millions of dollars converting a building to apartments that was never designed to be for apartments, with the hopes that not only that, you lease it up and at market rents, comparative to properties that were originally built and only built to be apartments. So I mean, kudos to those that do it and have success. I applaud you. It just seems insanely risky. Also, given the fact that that building you talk about or others, are delivering 24 months from now, possibly, maybe 18. But I think that is by far the most fascinating, will be the most fascinating development in the commercial real estate market, is how did those buildings perform that were converted when it's 2026 or 27 and we're looking in the rears. I'm really excited to see how that plays out.
It's also super expensive. Think about the investment in plumbing.
Plumbing. How about every single trade that you can think of, top to bottom, would need to be rethought, redesigned, and probably ripped out and start over. I mean, if you're an owner of one of those buildings, hate to say it, you're better off defaulting on your loan and go and buying a different one at a much lower basis where someone else defaulted. So you could start with a basis that's a third of market value if it was a performing office building, right? It's because if your basis is after 2016 or 17, then you're adding another $300, $400, $500 a foot in conversion costs. Now you've got a basis that's through the roof. Like, how do you make money on that? It's going to be really challenging to see that play out.
That's what I'm saying. I just don't get it. I mean, it's whoever's funding these endeavors. I mean, you're swinging for a home run, and only a home run is what makes sense. I mean, a double, a triple, proverbially speaking, just doesn't hit the returns you're going to need. But again, excited to see how this plays out. And for those that succeed, kudos to you for seeing it forward. And I applaud the effort.
So this is not the scenario that this particular owner is in, but I mean, just thinking through what types of scenarios would it make sense? And I think it would only really make sense in a scenario where you own the building outright or you have a very high amount of equity on the building. And the idea of, walking away from the equity you do have in the building in whole, by defaulting on the loan, doesn't make sense. So it's definitely not the situation here. I think there are a lot of people in that type of situation that maybe you're just not thinking it through fully. I mean, it is strange. Maybe this particular owner, which I know has a meaningful amount of debt, has like cross collateralization with other buildings or something like that. But I agreed, it is weird behavior.
Can I change the topic quickly here? Which something that came across the wire that I should have remembered to talk about was if anyone's seen, so Alexandria Real Estate is a large life science REIT that's national, and this activist investor, it kind of plays into a little bit what we're talking about, but this activist investor, Jonathan Litt, who's got a track record for shorting major office REITs, came out with a study in the last 5 days that looked at like 500 or 600 properties across the country. And what they found was, and his summary was that he was intending to go long on Alexandria because they're not an office REIT. They're insulated from this this carnage in the office markets. But what they found was that these life science buildings actually have a tremendous amount of office space in them. Then they dug deeper and they were using cell phone data to look at the occupancies of these lab buildings, and the occupancy was less than 50%. And then they were looking at the length of time that the people came into the building that were coming to the building, and it was less than or somewhere at around 5 hours. So if you're a researcher, you're coming into the building, you're doing your lab work, and you're leaving. So it became this major story that's impacting Alexandria in a major way, in the markets. But it's just a very, it's a very thoughtful analysis just below the surface of an asset class that we thought, especially well leased to big pharma, well leased to quality tenants, would be insulated from this. But this study has really shaken a lot of investors and credibility for a REIT like Alexandria. Wanted to get your thoughts.
I think that the bull case on Alexandria, before this report came out was, hey, look, this is one of the longest standing and largest developers of life science space. They really know what they are doing, and they were well ahead of this life sciences correction. I mean, they stopped all new development, I believe 18 months ago, somewhere around then ago, to, hoard cash, be in a position to weather whatever life sciences, pullback was coming. So they're better positioned than probably just about anyone in the life sciences space. That, of course, doesn't mean that they're fairly valued, right? It does mean that they probably have the staying power and probably will come out on the other side of whatever happens with life sciences in the coming months or years significantly better than anyone else that owns that type of product type. But I agree. I think it's very likely that life sciences is overvalued based on some of the information that came out of this report. I mean, if people aren't using space over time, I think that the amount of money people spend on space is going to have some correlation with the amount of usage of those people. And it's a matter of, is there a way to get out of these spaces, take less space in a more cost-effective manner without incurring hundreds of dollars per square foot in rebuilding labs and opportunity cost of not having labs up and running. And that's the part of the study that I think maybe could be further diligenced, right? I mean, people assume that everyone's going to operate perfectly rationally. And in my experience, and I'm sure your experience in working with a lot of companies, people don't always, one, operate perfectly rationally, but two, for life science companies in particular, there's a very big focus, especially right now, on eliminating large one-time expenses. And you think about the cost to relocate a life sciences building, it's just so expensive. So will people be willing to pay more rent for space that is too big or, oversuited for what they need to avoid moving? Probably, but not forever. And it's just a matter of how quickly does this impact occupancy levels of these asset types.
Yeah, and let's not forget too, guys. I mean, I read all about the short on ARE by Jonathan Litt, and the first thing that came to my mind was, wow, well, let's just say he's right, okay? If he's right, think of how distressed all the other people are that during the pandemic who were not life science developers nor life science owners of real estate. Think how in trouble they are, that all rushed to buy these office buildings that they were told by others that, oh yes, this is a conversion. Like there was a tremendous amount of conversions. I think we've talked about that in a previous podcast where office owners were looking to life science as kind of the lifeline, so to speak, to save their office building and convert it to life science. Those guys all did that, in the last 36 months. And if ARE is in trouble, you have wait for the tsunami to hit the life science market for those people that bought buildings, did conversions that are still, by the way, sitting vacant, at least in my market. So I'm not suggesting Jonathan's wrong. Obviously, he's got a history of shorting things. He shorted the office market during the pandemic. But my only take is, I think we're picking on the biggest life science REIT because they are who they are. But again, if they're in trouble, we've got major systemic problems throughout the life science community for those other smaller landlords.
By the way, so I'm not predicting what may or may not happen to the value of ARE stock or life science stocks broadly. I will challenge his methodology, this idea of the cell phone data in the office usage in the biotech lab building. I'll just say this, the whole short game is an interesting game where, coincidentally, he's got this really interesting method that he's used to track cell phone data, and it's showing a weakness that wasn't there before, and it's getting all this media attention. Okay, that serves a purpose. I mean, that helps his short position, presumably, as he gets everybody thinking and worrying about ARE stock price. So there's a whole, but I think it's misguided because most lab buildings are comprised of lab and office. And the fact that the lab companies aren't going into the office as much as they were before, okay, but they can't bifurcate the office from the lab. They still need the lab, presumably, if they're conducting studies. So using that cell phone data to say people aren't going in as much as they were before, I believe is misguided. They're still
And
going
John,
into
I
the
think
lab.
you do a lot of life science work like myself, and I've never had a life science company tell me they can bifurcate the office from the lab. Because keep in mind, for our listeners, a lab building has both what John was just talking about, lab space and office space, okay? But they charge, the landlord charges a rental rate on the entire space. They don't bifurcate the rent for, say, hey, this is what you're going to pay on the lab portion of your premises, and this is what you're going to pay on the office. It doesn't work that way. You get one rate for the whole building, okay? And so sometimes we've seen rents for office space being a third of what they are for lab buildings. So presumably someone that wants to save money might say, well, why don't I put my lab in the lab building and pay $80 a square foot on a net basis and put my office in an office building and pay $30 a square foot on a net basis, and therefore save money. But that then puts them in two buildings, potentially blocks apart, or maybe, a mile apart. I've never seen that happen. Now, for the large life science companies who occupy hundreds of thousands of square feet, sure, maybe they put their administration, back office functions in an office building. But for the traditional life science company that could be between 5,000, maybe even 80, 100,000 square feet, are they bifurcating their office and lab? No. And so I think, John, to your point, I would agree with you that the cell phone data is a little, to base your entire short off that, maybe among other things, I think is short-sighted.
I think what you guys are saying is I don't disagree, but I do disagree. the thought is, first, can you get more efficient in the office space? Do we need as much space? If people aren't utilizing it at the same level, do we need, if we're 100,000 feet, do we need 50,000 feet of office, or can we be 75,000 feet? Because the cost of the office is the same as you're paying for the lab, right? So can we downsize? That's the first thing. And I think the answer is proving out already. The answer is yes. The second thing is the market's softening already. So companies are trying to find a way to extend existing rounds. If it's a 12-month round, they want to push it to 18 or 24 months, right? So companies are trying to find a way to be more efficient. We went from effectively 0 subleases, say 18 months ago, to almost 2 million square feet of subleases on the market overnight, right? Over that time frame, not overnight. The third piece is, I've heard this, we can't bifurcate. You know who else used to say that ad nauseum? Medical users, hospitals. They couldn't, you need to have the offices for the doctors on the campus. You need to have the medical space next to the office space. And you know what the hospitals have done over the last 10 years? They've pulled all non-medical uses off of their campuses and put them in lower cost locations. So to me, long term, does this data mean that overnight we're going to see ARE, who I truly believe is the best landlord or one of the best landlords in this space, and they're going to be fine? Do I see a huge sea change in this over the next cycle? Yes. I think companies are going to have to look at this differently. And the last point is, in this market, ARE just put on the market and sold a 5-building portfolio. And what we heard is that is to fund the improvements of a development under construction out at the old Arsenal in the Charles in Watertown to finish that development. So are they thinking about their portfolio differently? As we talked, they are forward thinking. They are in a position to probably fund that off their balance sheet or raise cash to do it. Instead, they chose to sell 5 kind of suburban, a couple of them are in Cambridge, but 5 kind of non-core assets, if you would ask me personally, to fund a core assets completion and conversion. So are they forward thinking and saying, you know what, we need to divest of some of our non-core stuff now as well and double down on the stuff that we know is going to be core in the future?
Okay, some final thoughts on this short position on Alexandria before we move on to another topic and then wrap up the show. I think Warren's saying that none of us are confident enough after reading his report to be short Alexandria Realty ourselves, right? Like, this is a risky proposition, even with the major macro headwinds on the life sciences space. So that's number one. Number two, I think we can all agree, as said by several of us already, that Alexandria is among the smartest people to invest in life sciences real estate, bar none. And if Alexandria has issues, it means everyone else is probably going to have at least equal, but probably much worse issues than Alexandria Realty will. If I had to buy a life sciences REIT stock right now, I would be buying Alexandria over anyone else's. And I say that with like surface level of research in these things. It just, other REIT stocks are going to be equally, if not more, pummeled. On the other side of this, well-capitalized REITs like Alexandria are probably going to pick up market share and be able to perform really well. That doesn't mean, buy, but it means that once there is a price correction, that probably is a very good buy because they've proven themselves to be a top-tier investor in the space. What's happening in the life sciences sector, just to remind everyone, it's not just this giant wave of subleases that's coming on the market at a time where there's reduced demand and still a lot of direct availability coming to market. It's still primarily interest rates, right? So we're talking about these macro headwinds to life sciences, but the same headwinds are affecting all real estate product types. And it's the fact that, you probably could sell a, core life sciences building with a very strong, credit tenant, depending on which market and all that, at a 4 cap or something, and that's now a 6 or 6.5 or 7 cap, depending on maybe even higher, depending on who the tenant is, how much term there is, where the building's located, and the quality of real estate. So every single one of these buildings, particularly REITs that are valued day to day, right, where they have daily valuations of their buildings because they're publicly traded, of course, are going to be really struggling right now.
And by the way, what we're seeing in the way of a pullback is a pullback from an exaggerated, there was such a mad rush into life science to the rescue during COVID. A lot of first-time investors into early stage biotech companies. It was so exaggerated, the push into life science, that this pullback we're seeing is to reduce from that exaggerated mad rush in. So you're going to see a lot of follow-on investments that don't occur. These companies live with 1 and 2 years worth of run rate, burn rate, and so it's not just life science slowing down. It's life science slowing down off of a crazy accelerated high that was exacerbated during the COVID, life science to the rescue era.
Yeah, and we could talk about this all day long, but the other point that I was listening to yesterday in a meeting was construction costs to build buildings really are continuing to increase at alarming rates, right? People are talking about the supply chain coming back to normal. Inflation on true hard costs is still extremely high. So the costs when you underwrite the construction of a building, and it takes you, years to permit it, years to underwrite it, you have all this rent growth in your model, and your costs are still going up, and your rent growth is flattening out. Even if it's just flattening, if it's still to the upper right, but it's just a little flatter, it's going to really challenge some of these investment models for new construction. And as soon as you start to see the pullback, interest rates, and then a flattening of rents and continued increase in construction costs means construction is going to dry up across this asset class, but many asset classes. That behind that period is always a really challenging period for tenants, because you have low supply and when demand comes back, a higher demand. So it's not a good thing for anyone, I don't think, if this environment continues, because if you can't keep supply and demand at equilibrium, it's not great for developers now, and it's not great for tenants in the future.
Okay. Very interesting podcast today. We are out of time to be able to talk about international market stuff and appraisals. We will be covering that in a future podcast. Thanks so much for listening to episode 13, and we will be back with episode 14 soon. Heads up to our listeners that over these summer months, we're going to be sticking with a shorter episode format, right around 30 minutes instead of around an hour, mostly sticking to a handful of interesting news topics that come out. And we will be sure to also cover international market and appraisal things on one of those episodes in a short window. Thanks so much.